Good afternoon and welcome to Scotia iTRADE's webinar. Today's topic is on Introduction to Index Options with the Montreal Exchange. So you should be able to hear us now. If you please click on the sound check panel from the audio panel just to test your audio. And just do some quick house cleaning items here. Possibly if you could just give us a quick hands up if you can hear me okay by using the hand icon there. Thank you. Barbara, Dennis, Henry, thank you so much. Ian, Les. So I suppose we're all hearing. If anyone is having difficulties listening in, you can just use the sound check link in the audio panel. This may show up as a settings link, and that might be on the second screen just in case, right? If you're having issues, if you're calling in, if you're using your computer speakers and you're having issues hearing, you can just call in using the telephone. Just don't forget to use the access code and your audio PIN ID as shown on the screen. So as a quick reminder, Scotia iTRADE does not provide investment or tax advice or recommendations. Nothing in the presentation here should be construed as investment or tax advice or a recommendation to buy, sell, or hold any security, or to follow any particular investment strategy. The presentation is for information purposes only. So the toolbar that you see there on the screen can be used to navigate the GoToWebinar system. If it should hide itself, because the platform at times does that, you can just use the arrow to let it reappear again. You can also view full screen mode. If you have any questions, you can use the hand icon there, or just type in the question in that question panel box you see on the bottom, and we'll be able to address that. Now, this will be a bit of a longer presentation, so we're going to try to leave the questions to a Q&A period afterwards. However, should there be any points of clarification, then our presenter will certainly address those at the time. So feel free to list your questions down, and at the end of the session, at the Q&A part, we'll be able to address them all at that time. So we are going to be recording today's session. A link will be emailed to you within 1 business day, so tomorrow. If you want, however, you can always visit our YouTube channel. We have a webinars on demand playlist there, where you can see all the past webinars archived on site. Just click on the YouTube link at the bottom of the screen, ScotiaITRADE.com, to see that link. You can also email us at education@ScotiaITRADE.com to request a copy of the webinar. Lastly, I'll be providing you a link to download the presentation at the end of the session. So once we finalize or conclude, just give us a few more seconds and that link will be provided to you. You can click on it and download the presentation. So you can take notes, but the handout, as I mentioned, will be there for you at the end of the session. So today we have with us Jason Ayres, I hope I'm getting that right, from DMS. He is a Montreal Exchange instructor. He's been with the Montreal Exchange for several years as an instructor. He actively advocates and educates investors on the practical utilization of options for managing risk, cash flow, and leverage. In addition to the development of numerous strategic relationships with some of the most prominent brokerages and exchanges in North America, Jason is the president of Learn to Trade Global, as well as founder of OptionSource.net. He's also a derivative market specialist by designation. I'm going to turn over the presentation to Jason now, who will take you through the rest of it. Thank you. Jason?
Fantastic. Hi there. Thanks very much for having me this afternoon. So what I need to do right now is just make sure that you guys are able to see the presentation here. So just bear with me 1 second. We're going to all right, here we go. Okay, so as Conley sort of instructed, just a quick hands up just to make sure that everybody can in fact see the slides for today's presentation. All right, okay, good stuff. So as mentioned, we're actually going to be taking a look at what we refer to as index options, and or specifically SXO options, which are options on the S&P TSX 60 index. Just to once again sort of echo the disclaimer that you heard earlier on, we want to make sure that everybody understands that this is for educational purposes only, and make sure that you certainly educate yourselves on the risks associated with utilizing options and any financial security for that matter before you in fact go trading for yourself. So what we want to accomplish over the next hour is sort of gain some understanding as into what in fact an index is. We're going to take a closer look at SXO options, and I just want to give you a couple of examples within the presentation on how you can use these options to trade a directional bias, and then we'll compare the utilization of these options to buying shares in the XIU, which is the ETF that tracks the S&P TSX 60, versus utilizing the options. So what is an index? Well, first of all, an index is a method of measuring a stock market, and an index can in fact represent a broad equity market or a specific industry sector. Now, most indices are what we refer to as notional, and what that means is that you're actually not buying and selling shares of a particular index. That index is used as a way for benchmarking, movements in the security's value, but other securities are priced based on the index. So again, you're not buying and selling shares on the index themselves, but other securities are priced based on the value of the index. So there's a couple of different ways that that indices can be weighted. We have price-weighted indices, which is essentially taking an arithmetic average of all the stocks within the index. So most of you are familiar with the Dow Jones Industrial Average. So the Dow Jones is in fact a price-weighted index. We also have market-weighted indices, and so what this type of index does is it divides the market value of each stock by its total market capitalization of the index, and then weighs its impact on the index. So an example of that would be the S&P TSX 60. So depending upon how significant the market capitalization is of a particular security, it will influence its weight and impact on the index accordingly. We also have what we refer to as global stock market indices. So this is a way that we can actually benchmark the performance of the equity markets in general around the world. So there's the MSCI World Index, or there's the S&P Global 100, right? So we can look at indices that are reflective of specific countries. We could look at indices that are specific to particular sectors of a market. And we could also look at indices that are reflecting the value of all equities around the world. And again, just to give us a general idea as to how the publicly traded markets around the world are performing collectively. Now, quite often when you're tracking the markets, and maybe you wake up and you put BNN on or CNBC on, you'll see different indices being quoted. So typically what you'll see for the United States is you'll be looking at the performance of the Dow Jones or the S&P 500. In Canada, there's the S&P TSX Composite, and Japan has the Nikkei 225. British has the FTSE 100, and Germany has the DAX 30. So a lot of investors will more or less just use these particular indices as sort of a way to get a feel as to how the global markets are trading on a day-to-day basis. There are also sector-based indices. So if you want to get a feel for how gold is trading, for example, or gold mining stocks, then you can track the S&P TSX Global Gold Index. We also have the Capped Financials Index. We've got Capped Information Technology Index. We've got Capped Energy Index. So what these particular indices do is they give us a collective measure of how companies within those particular sectors are performing. right? And a lot of investors, rather than trying to be stock pickers, if they have an interest in gaining exposure to a particular sector, they'll choose to use an index or an index-based ETF or a sector-based ETF to gain that exposure. And then you've got a diversified exposure across a basket of companies within a particular sector versus trying to figure out which is the best one out of it. So what is the S&P TSX 60 index? Well, this is in fact one of our leading benchmarks. It essentially tracks the large cap segment of the Canadian equity markets. It tracks 60 of the largest companies listed on the TSX, and it includes companies from 10 different sectors. So you've got your materials, you've got your financials, your consumer discretionary, telecommunications and healthcare, industrials, energy, consumer staples, and information technology, as well as utilities. And so these particular sectors tend to stay the same, but their weightings or the exposure that the index tracks to each of these particular sectors may vary. So one of the considerations for Canada is, of course, our energy and our financial. So you'll recognize here when we take a look at the sector weightings of the S&P TSX 60, you've got about 41.1% of the index weighted in Canadian financial. So of course everybody loves Canadian banks, and as a result, that's why there's there's a significant exposure there. They're some of the largest capitalized companies in Canada, and of course Canada is also well known for its role as an energy player, and so you've got the next largest holding in energy at 22.2%. This is actually as of February 28th, 2017, in terms of the weighting. As I said, sometimes it will change from time to time, but for the most part, you can see that in general, we're most heavily weighted in the financials and in energy, and then followed by material, industrials, and so on. So why is this important? Well, you've got a market capitalization of about $1.4 trillion tied up within this index. So it gives us a really significant insight into the overall direction of the Canadian equity market, and more importantly, the Canadian economy. So again, rather than looking specifically into a particular sector, this gives us a broad-based view of just what's happening, with Canadian companies, publicly traded Canadian companies. Now, the advantages of utilizing an index, there's really three main considerations. Number one, it's relatively simple. So if we actually are, as I mentioned earlier on, looking to, maybe more heavily weight our portfolio into one particular sector, then we could use a sector index in order to gain that exposure, rather than purchasing, 10 different securities and paying commissions and having to manage 10 different positions within our portfolio. We could use a sector-based index to gain a exposure to a broad-based group of Canadian companies that operate within that particular sector. Low cost, again, when we look at the transaction costs associated with buying and selling these different securities, you have a much more cost-effective way of gaining exposure by simply buying an index. And finally, diversification, right? So once again, whether you're looking to just gain a general exposure to the Canadian markets, or whether you're looking at being more sector-specific, within that particular index, you actually have a broad-based exposure to what I would say you would consider to be the best of companies that are publicly traded, that do business within the energy sector, or within the mining sector, or within the telecommunications, or what have you. So rather than trying to find the best company and then buying that best company, you are buying a basket of companies. And what you're doing when you're diversifying across a number of different companies is you're actually mitigating some of the risks associated with any specific management-related issues, or any other sort of unique issue associated with one particular company. What this is doing is it's mitigating that risk across a number of different companies. So, for example, if if it's a basket of tech companies, we think back to Research in Motion. Well, if you just held RIM, when things went bad, well, you're bearing the brunt of that entire exposure. Whereas if you are invested in an index within that particular sector, while that's going to impact the value of that index, it's certainly not going to have the same impact to your portfolio because any sort of risk has been mitigated across other companies that ideally are not subjected to the same risks as the one company that has been. So what's an index option? Well, an index option is priced based on the level of the S&P TSX 60 index. And so we can use these index options. I think one of the most powerful ways to use these index options are to hedge a portfolio against a broad market decline, right? So the interesting consideration there is if you have hold a portfolio of diversified companies and you are concerned about one of those companies, well, then the solution is you could go in and you could build a hedging strategy utilizing options specific to that company. But the challenge is if you are concerned about a broad-based market sell-off, then the challenge becomes you have to go in and buy put options or build some sort of hedging strategy around each and every one of those positions. Whereas you can in fact use an index option and hedge against that broad market risk within your portfolio without actually having to buy puts or create collars or any sort of hedging strategy around each individual company. Now, you can also trade a directional bias on the overall economy in general with a limited and identifiable risk exposure. So if we take a look at the trading parameters, what we want to recognize is that the price of the contract is quoted in index points expressed to 2 decimals. So for example, we might have a quote of 907.75. And what that means is that each point, each one S&P TSX 60 point is equal to $10 on the option contract. So we have a multiplier of 10. And so if you move 0.10 index points, that's $1 per contract. If you move 1 index point, that's $10 per contract, and so on and so forth. And so as the index moves up and down, the value of the option contract will be adjusted by the multiplier. So strike price selection, strategy selection, all of that is really very similar to how you would approach a standardized option on on your favorite stock. We have an expectation as to what direction we feel the index is going to move, and then we would subsequently choose the strike price that is appropriate to meet those objectives. Now, one of the important considerations is that strike prices are listed in 5-point intervals, so it will vary from security to security depending upon highly traded those securities are, or even the price of those securities. So for the SXO option strike prices, we have 5-point intervals. And so let's say, for example, if the index is sitting at 907, and we're looking at a 1-month call option example, okay, strike of at $900 might be listed at $22.25. So that means that the cost per contract is $222.50. 905 strike might be worth $19.15, and it's worth, but based on the multiplier, it's going to cost us $191.50. So you can see how at each different strike price, we've got a different option premium. The contracts trade independently, no different than your typical equity options and ETF options that we've discussed in the past, except the difference is that it is a 10-unit multiplier, not a 100-unit multiplier, right? Strike prices available. Now, this is as of March 23rd when I was putting this presentation together. So you can, in fact, trade the April, May, June, Septembers, and Decembers of 2017. And then you'll notice that you can go as far out as December 2018 and even so far as December 2019. Right, so you've got lots of flexibility in terms of expiration dates to choose from. There are a lot of money managers that they may be looking to build a long-term hedge in place, and so they may be utilizing those December 2019 contracts as part of a longer-term strategy. So, once again, no different than how you would go through your strategy and strike and expiration selection process for equity options. You're going to do the same utilizing these SXO options as well. The pricing variables are quite similar to those of equity options. You've got the value of the underlying index. So again, very important to recognize that as the S&P TSX 60 moves up and down in value, the option contract itself will move up and down in value, and the amount that it moves up and down will be dependent upon its strike price and how close it is to the current level. Of course, you've got time remaining until expiration as a significant consideration, so no different again than any other types of options we've discussed in the past. Time is a very, very important consideration when looking at managing your position. Volatility, in fact, when we talk about the VIX-C, which is the volatility index for the Canadian markets, that VIX-C is based on the volatility associated with these S&P TSX 60 options. Any dividends, of course, the securities that are held within the index or are used to benchmark the index, a lot of them pay dividends, so that's factored in as well as the risk-free rate of interest. Now, really, really important consideration, and what makes this an interesting choice, particularly from a hedging standpoint, is that these options are what we refer to as European-style exercise. So what that means is that no securities change hands at the point of expiration. So this goes back to the understanding that the index is a notional index. All it is just a way of tracking value. No shares. It doesn't, you're not buying and selling shares of this particular index. So the reason why settlement would be what we refer to as European style and cash settled in Canadian dollars is because you're not going to receive shares of the index. You're going to receive the dollar value of that option contract based on the settlement price of the opening level on the expiration day. So that's, again, another important consideration is that those option contracts are priced on expiration at the open of the market, not at the close of the market. So what that means is that trading of those contracts stops on the Thursday or the day prior to the expiration day. So unlike your traditional ETF or equity option that you have until the end of the trading day on the Friday to manage out of, these particular contracts are going to be settled at the opening of the Friday. And once again, expiration very similar to the other types of contracts. It's the third Friday of the contract month, but the end of trading is the Thursday before that Friday. So very, very important to keep that in mind. What I will point out is that the value of utilizing these kinds of options from a hedging standpoint is the fact that one of the biggest considerations if you're utilizing options on a particular stock, if the stock drops and those options are in the money, you have to make a decision as to whether or not you're going to exercise your right to sell the shares, and then of course the shares are taken from your account, or you have to decide whether or not you want to just sell off the option contract and collect the profits. But there's a little bit more of a consideration involved in how to manage that position as you approach expiration. Whereas if you built a hedge utilizing these index options on your portfolio, and there's ways, in fact, we don't get into this today because we don't have the time, but there's ways that you can calculate the beta of your portfolio, for example, which is a reflection of how your portfolio will move up and down comparative to the index. And then out of that, you can calculate how many index options you should purchase to effectively hedge market risk. And so the value in being able to do this is that as you approach expiration, if your portfolio has dropped in value along with the market, those option contracts will have increased and will ideally be offsetting the dollar value that you are losing because of that sell-off. And then again, you can just allow those options to expire, and you'll receive the Canadian dollar equivalent between the difference of your strike price and the settlement value of the index itself. So if we take a look at a settlement example here, let's say we've got a call strike price at 900 and at expiration, the S&P TSX 60 is at 920. Well, the way that we calculate the settlement value is we take the index value and we subtract the call strike. So if the index is settled at 920 on that Friday morning on open, and you have a 900 strike call option, then your option contract will be worth 20 points, right? So then, of course, when we factor the cost associated with that, 20 points times the $10 means that the settlement value and what will be deposited in Canadian dollars is $200 per contract. So the SXO call option holder will receive a credit of $200, and the SXO call option writer, their trading account will be debited by $200. So no shares are delivered, again, because we're looking at a notional index. There are no shares traded. So no shares are delivered. The position is cash settled. Now, if we look at a similar example utilizing a put option, once again, we're going to look at a put strike at 900, and let's assume that at expiration, the S&P TSX 60 has dropped down to 875. Well, we take the put strike of 900, we subtract the index value of 875, and we get $15 or 15 points, per contract. Again, 15 points times $10 means that the settlement value is $150. So the SXO put option holder receives a credit of $150, and the SXO put option writer's trading account will be debited $150. No shares are sold, and the position is cash settled. So why would we use SXO options? As I mentioned, it's easier to use these options to hedge a broader portfolio, a broader base portfolio of stocks because of the cash settlement, right? And there's more certainty of when the options will be exercised in terms of just what the outcome is going to be. You know, either they're going to expire worthless or they're going to be cash settled. So, you know, you can create combinations. So we could create, let's say, a caller strategy around an entire portfolio. You sell a call option on the SXO, you collect the premium associated with selling that option, and then you subsequently use that premium to buy a put option, and all of it is cash settled, right? So doing combinations such as credit spreads, debit spreads, or callers, or building in a hedging strategy, you know, such as a protective put, we've got more certainty in terms of just what the outcome is going to be. As I mentioned, either cash settled, so we get the dollar value, or they're going to expire worthless. So there's a couple of questions here. I'm just going to maybe Barbara, I'll maybe hold that to the end. It's a great question, so we'll just maybe when we get to the end, we'll get Conley up to sort of moderate the questions, and we'll make sure that gets answered. But thank you for your question. So directional trading strategies. We're actually we're going to have a good amount of time for questions at the end. It looks like things are moving forward quite nicely here. So we'll make sure that we get back to you on that. So we're going to focus here for the last little bit just on taking a look at utilizing options for a directional trade. And again, you know, there's a lot of investors that are looking at trying to take advantage of a broader market outlook, right? Because it rather than it being a trade based on, you know, a company's expectations, whether it comes, you know, whether it's earnings or whether it's, you know, any sort of other consideration for a specific company, you know, utilizing an index option is more or less a, you know, you're trading your outlook on an entire economy, right? And so it just, again, gives you that sort of broader based, essentially you're gaining more exposure to banking and financials. You're gaining more exposure to energy. So keep that in mind with respect to the, to the weighting of the different sectors within the S&P. But, if you feel that those particular sectors are going to do well, then rather than trying to buy stocks specific to each sector, you could buy just an SXO call option. And so what you're looking to do is you're looking to take advantage of a move, in this case, let's say, for example, to the upside. You want that diversification, so you don't want to be selecting stocks individually, and you want to be able to take advantage of the leveraging capabilities of an option contract with an identifiable risk exposure. So again, remember that when you buy an option, whether it's an index option, an equity option, or an ETF option, that option, the risk as the buyer is limited to the credit to that, or sorry, to the debits paid for the contract. Now, question becomes, what contract do we select? Again, this comes down to what is your forecast. If you are expecting that the market is going to strengthen, or the Canadian economy in general is going to strengthen, you're going to buy a call option. If you have an expectation that the market's going to weaken, you are going to purchase a put option to trade that directional bias. So in terms of expiration month, again, we need to recognize that the same risks associated with buying an option as somebody utilizing an equity option or an ETF option apply to an index option. There is a specific expiration date if the underlying security, in this case the index, has not moved sufficiently enough to accommodate the cost of the option, then it's going to expire worthless. So we need to make sure that that we're managing accordingly. So short-term options, of course, give you a smaller window of time to be right, but they're less expensive. So a lot of times people will use an index option, for example, on an event-driven strategy. Maybe it is a Bank of Canada interest rate announcement, or maybe it's oil inventories, or something of that nature. But you can utilize a shorter-term option to trade that very event-specific opportunity. Your longer-term options are going to give you more time, but of course, time is money. So it's going to cost you more in order to have a contract that has a longer dated expiration month. So if we circle back to the list of expiration dates currently available, you'll recognize, of course, that the April option contracts are going to be significantly less expensive than the December 2019 contracts. But as the old saying goes, different strokes for different folks. People utilize options for many different reasons, and so again, depending upon what you're trying to accomplish, you might use a short-term or a longer-term contract to trade that outlook. The strike price, of course, determines the level which you have the right to buy or sell the underlying contract, but recognize again, because it's, or the underlying security, but again, recognize that that we're trading a notional index. We are essentially benefiting from the difference between the strike price and the settlement value. And if the option is held until expiration, it will have an intrinsic value if it's in the money, in which case it'll be settled for the Canadian dollar equivalent, or it will expire worthless. And of course, option prices reflect the probability of being profitable, right? And that probability is essentially based on expected volatility, expected price fluctuation. So one of the interesting considerations with not just the Canadian market, but with the US market in general, is that we've been in a very low volatility environment. In fact, you guys can check out our presentation in the archives on volatility. And so one of the considerations in a low volatility environment is that it's a, option contracts for the buyer are what we would refer to as being reasonably priced, right? So you're able to take advantage of buying options, calls or puts in a low volatility environment with the expectation that volatility will increase, and that will influence the value of the contract and help with our profitability. So let's look specifically at buying a call option. So once again, the investor would expect that the S&P TSX 60 is going to strengthen or go up in value, and the choice to participate is to buy a call option. So if we were looking at the values, let's say on March 23rd, there just last week, the index was sitting at 907. So we could look at buying a 910 strike call option, which is just slightly out of the money, trading at $26.50. So remember, there's a 10-unit multiplier. So that would cost us $265. Now, what you'll see here is that we have essentially a little profit loss graphic here. If the index is trading at 910 on expiration, it would expire worthless, and you'd lose your entire premium. So you can see essentially what we need to consider is, where does the index have to be in order for us to break even? So if we purchased a 910 strike call and we're paying $26.50 per contract, or $265, on expiration, the index needs to be trading at $936.50 just to break even, because that compensates us for all the time value that's disappeared. And then that contract needs to have some intrinsic value beyond that in order for us to profit. So you can just kind of see here how as the index drops in value, our maximum risk stays the same, but as the index increases in value, that's where we have the opportunity to profit. And that profitability is unlimited, provided that, of course, we have it's unlimited up until the point of expiration, in which case the option contract would be settled for its intrinsic value. So again, we calculate our break-even point no different than our ETF or equity options. We simply take our strike price and we add the premium, and that's where the underlying security needs to be just for us to break even. And in the case of the call option, it needs to then be trading above that on expiration. Now, keep in mind, you can actually sell these contracts at any time before expiration. So, we don't have to wait until all the time value has disappeared, relying exclusively on intrinsic value to benefit. If we get a significant move in a short period of time, we can certainly cash that position out to lock in our profits if it makes sense at that time to do so. Now, the other side, of course, to the market is the bearish side. And so if we have an expectation that the markets in general are going to drop, then what we would do is we would buy a put option to participate. And so if we take a similar price point here, S&P TSX 60 sitting at $907, and we're going to look at a slightly out of the money put at the 905 strike, then we would be paying $30 per contract, but the multiplier is 10, so that's going to cost us $300. Now, this is where we can kind of maybe wrap our heads a little bit around how this might work as a hedging strategy as well. So whether we're utilizing these puts to trade a directional bias, or whether we're considering this as a hedging strategy, ultimately what we're doing is we're paying a premium, right? So let's say, where I would sort of rationalize this from a hedging standpoint is, let's say we've benefited, we're up 7% on our portfolio, for example. Well, if we're comfortable with a 6% profit or return over the course of the year, maybe what we want to do is we take 1% of the profits that we've generated, or the returns that we've generated, and we use that to buy protected puts. And we know that the most we can risk when we purchase those protected puts is the cost of the puts. Now, I should preface that by saying the most we can risk up until these puts expire is the cost of the put option. So you can see here, if we're wrong, and this is an interesting consideration, if we're wrong and the markets continue to move higher, well, our loss is limited to, in this example, the $300 that we've paid, but all of the underlying securities within our portfolio should be moving higher and ultimately compensating us for that cost. Now, on the other side, if the markets continue down and the securities within our portfolio are selling off, the value is that we have this protection in place that is increasing in value and offsetting the dollar value loss associated with the shares that we're holding. And then, as I mentioned, ultimately on expiration, those options would be cash settled for their intrinsic value. Right. So a couple of considerations. The position can be closed at any time prior to expiration. Again, I mentioned that already, but very important to recognize. No different than any of the other options we've discussed in the past. You can buy and sell these options during regular trading hours at your discretion, so you don't have to hold until expiration. The last trading day is the day before the expiration Friday. So again, if you're looking to manage out of your position, it's got to be done before close on the Thursday, because the value of the S&P TSX 60 at market open on the Friday morning is the settlement value for that particular expiration cycle. And again, cash settled in Canadian dollars. So no securities exchange hands. You're not going to get 300 shares of Scotia and 200 shares of Enbridge and 500 shares of something else. It's just simply cash settled in Canadian dollars, right? And you continue to hold all of your pre-existing underlying securities. So what can we do at expiration? Well, we can let the option be exercised because all that means is that we're just going to have the cash deposited in our account, or we let the option expire, in which case it expires worthless. We can close the position, but again, you have to consider the fact that closing that position or letting it be exercised is essentially the same thing, and that both those approaches will result in a cash settlement in Canadian dollars. The other considerations, you can roll the position. So let's say you've run out of time with your put protection, but you feel that there's still risk associated with being exposed to the broader markets. You just simply buy back, you simply sell the existing put option and ideally monetize the profits there, and then you use those profits to buy a longer dated put option and maybe at a different strike price depending upon what's happened within the index at the time. So you can either let the option expire, you can exercise your right to close the position. You could just simply, you could let the position be exercised, auto-exercised. You could close the position by selling it back to the market, or you could roll the position if you wanted to, continue with that protection into the next month. So many of you might be familiar with the S&P TSX 60 Index ETF, which is known as the XIU. So the XIU, in fact, is priced based on the S&P TSX 60 Index itself. The difference is, number one, it's priced at a portion of the index value, so that it can be bought and sold easily by the average investor. And it's also there are also shares that trade based on this. So you can buy and sell shares of the ETF. So let's compare the XIU shares to that of purchasing the options on the index. So if we buy the options, using the options will require less upfront capital. Remember, anytime you use options, you're taking advantage of being able to leverage your capital. So leverage simply means that it takes less capital to control a larger position of the security. The other difference is that the SXO options have a definable risk exposure, so you know exactly what your risk is. It's the premium that you've paid. It also allows you to short the index without needing to borrow shares. So what I mean by that is, you know, most investors are, you know, comfortable with buying securities, buying shares, buying, you know, ETFs, that sort of thing, but not so much with shorting, you know, which is essentially, you know, selling something you don't own and looking for it to go down in value so you can return it at a cheaper price and keep the difference. So by utilizing put options on the SXO, it allows you to create that short exposure, you know, or benefit from a directional bias to the downside without actually taking on a short position in the security. So quick comparison as well, and very important consideration. Once again, SXO index options are European style exercise. Comparatively, the XIU ETF options are American style. So if you buy the XIU options as a replacement strategy to buying shares of the ETF, you have to understand that the deliverable is are in fact shares of the underlying ETF, 100 shares for every one contract. So you do have to be considerate of that on expiration versus the European style, which, as the next point suggests, is cash settled, right, comparatively to the underlying security being deliverable. With the index options, they're exercised only on the expiration day. Reason being is that there's no shares to exchange hands, so there's no real value in having any sort of early exercise, whereas the ETF options can be exercised and the option writer can be assigned anytime. So same, you know, same considerations as, you know, as somebody who is, you know, buying and selling, more importantly, selling options to generate cash flow on an ETF or a security. You may be assigned at any given time, where that's not going to happen with the index options. Once again, the SXO tracks the cash index, whereas the XIU tracks the underlying, or the XIU options track the underlying ETF. So the SXO tracks more closely the market value, whereas where the XIU ETF options are tracking the ETF, which is tracking the index. So you just got sort of 3 degrees of separation versus 2 with the ETF option. So before we take questions, just want to remind everybody that we've got lots of great content at optionmatters.ca. We've got also options trading letters, videos and webinars. In fact, at m-x.tv, there's some good content that is specifically focused on hedging using index options, which is something we didn't have the time to get into, but I touched on. And so for those of you that are looking for a way to hedge a diversified portfolio without having to buy puts on every single one of your securities, it's a really interesting consideration. Of course, there's also options calculators, covered call calculators, and a trading simulator available as well at m-x.ca. So I'll turn it back to headquarters there, and Conley, if you want to regain control and continue to moderate, I'll answer any questions that folks have.
Okay, perfect. Thank you so much, AJ. There were 2 questions listed so far, and I'll just quickly read out. The first one was from Barbara. Could a person use the SXO options if they're starting out as a new trader with a small account?
Yeah, I mean, the thing about utilizing any option is the requirement to have the amount of cash needed to buy the particular contract. So as long as you have sufficient enough capital within your trading or investment account, then you should have no trouble purchasing a call or a put option on the SXO to participate in your directional bias.
Perfect. Barbara, I hope that was okay. We have a second question from Dennis. He indicates that the page, you're welcome, Barbara. The page before the put strike was 900 and settlement was 875. The figure used in the PowerPoint was 15 points. And his question is, shouldn't it have been 25? I believe that might have been page 17.
Yeah, was there a calculation error there? That's actually a great observation. You may very well be correct on that. The consideration is that you're taking the index value at 900, and then subtracting the strike price, or sorry, you're taking the strike price. In the case, was it the put option he was referencing? Sorry.
Put option, right? Correct.
Yeah. So you take the put option strike and then subtract the settlement value. So if the put option strike is 900 and the settlement value was it 885? I believe is what he was suggesting
875.
there.
875.
Was it 875? Then yes, he's correct on that. Absolutely. So good call on that, and you win the prize for the day.
Great. Thank you, Dennis, for that question. And the other question, Tom has mentioned, with the XIU buy call, there is the underlying stock. Who gets the dividends?
Well, the dividends are calculated back into the ETF. So if you consider what the basically what an exchange traded fund is a basket of securities. So the ETF itself is the value of that is calculated based on the dividends that are being distributed.
Okay, great. Tom, I trust that was okay. Yes, I see the hand up there, Tom. Thank you so much. Great. Well, thank you so much, AJ. That was amazing. Good learning for us all. If there's any other questions, you're welcome to type them into the question panel. So I'll be doing the closing remarks now. So if you have any other questions, you can type them in. If necessary, I can send them over to Jason, who will address those for us.
Okay, perfect.
Thank you so much, Jason. That was a great presentation.
Yeah, my pleasure. I appreciate everybody joining in today. If there are no further questions, I'll maybe wrap things up here. I'll go on mute.
Perfect. Thank you.
Thanks.
So for next, oh yes, definitely, I will be sending the slide out to you. No worries. So yeah, for next steps, then you can access the webinar recordings on our YouTube channel, or you can email us at education@scotiaitrade.com to request a copy of that link. Don't forget to complete the post-event survey. This helps us to just gauge how well we're doing. If there's any need for improvement, which there will always be, continuous improvement, please complete that survey so that can keep us abreast of your needs. Mark your calendars going forward. We'll have the Pro Market Advisors providing us with an intermediate level webinar, Trading with Leverage. And this will be Tuesday, April the 4th at 1 p.m. Next, we're going to have an advanced webinar brought to us by the Market Guys. It's Strategies for a Bear Market, and that will be on Thursday, April 13th at 1 p.m. And the Montreal Exchange will join us again next month with another presentation. In order to register, as you may know, just please go to the education link on our iTRADE.com site. Under the events calendar, you can register for any one of the webinars that are coming up. And in addition to that, you can get the archived webinars at our YouTube webinars on demand playlist as well. So on behalf of Scotia iTRADE, I would like to thank Jason and the Montreal Exchange, and I would like to thank all of you who have joined us today. This was a great presentation. I hope that you were pleased with that. Please let us know how we're doing with that, and I will go forward. At this point, I am going to just attach the deck, and you'll be able to address that. You'll be able to get that. Just bear with me one moment. Okay, it's actually going great. The link is now there for the deck to the webinar, so you can download those as you will. And I appreciate your time. Please let us know. You can always send us questions to the education@scotiatrade.com if you have any other questions. Thank you so much. Have yourself a great day.